Hey everyone, welcome back to Corporate Dakota, the place where we uncover what is really going on behind those fancy corporate filings. Today we are looking at a company that made a big financial move. Let's just say they really put their money where their mouth is, or perhaps more accurately used other people's money to do it. Stick around to find out who and how. Before we dive in, if you are new here and you like getting clear, no-nonsense explanations of complex financial documents, do me a favor and hit that subscribe button. And for those of you who love dissecting these reports with a community of like-minded folks, our Discord server link is in the description below. Alright, so what we have here is a Form 8K filing. Think of this as a super important heads up to the public about significant events happening with the company. This particular report is about Cleco Power LLC and its parent company, Cleco Corporate Holdings LLC. The big news dropped on the 18th of November 2025. The main event here is that Cleco Power LLC basically took out a huge loan. We are talking about $350 million. They issued what are called senior notes, which is just a fancy way of saying they borrowed money with a promise to pay it back with interest by a certain date. These notes are for a whopping $350 million and they are set to mature in 2036. That is a lot of years. So who lent them this money? It was a group of financial institutions led by Credit Agricole Securities USA Incorporated, JP Morgan Securities Incorporated, and SMBC Nikko Securities America Incorporated. These guys are essentially the middlemen who helped Cleco sell these notes to other investors. Now, what are they doing with all this cash? The company says they plan to use the money for general business purposes and, importantly, to pay off some existing debts they have under their credit agreement. This is like swapping one big debt for another, but hopefully on better terms or to improve their cash situation. Let's talk about the interest rate. They are paying 5.300% per year on $350 million. That is a pretty substantial amount of interest they will be paying out every year. This just goes to show how much these companies rely on debt to fund their operations and growth. Here is something interesting. Cleco has the right to pay back these notes early, but there is a catch. If they pay them back before the 15th of October 2035, which they call the par call date, they will have to pay a premium. This is called a make-whole provision. It basically means the lenders will get paid as if the loan still had its full runtime, or close to it, to make up for the interest they would have earned. But if they pay it off on or after that date, they just pay back the principal plus any unpaid interest. This gives Cleco some flexibility to refinance if interest rates drop significantly. This part is about the actual deal. They signed a purchase agreement on the 18th of November 2025. This is the contract where the company agreed to sell these notes and the representatives agreed to buy them. These kinds of agreements usually come with lots of promises about the company's health and legal standing, and also details about who pays if something goes wrong, like that indemnification part. This is a crucial detail. These notes were not registered with the Securities and Exchange Commission under the Securities Act of 1933. What does that mean in simple terms? It means this was a private sale, likely to sophisticated investors who are comfortable with less regulation. It also means these notes cannot be easily bought or sold by the general public in the United States unless there is a special reason. Now, let's talk about the strings attached to this loan. The document governing this debt, called the indenture, has some pretty standard but important rules. These are called restrictive covenants. They limit what the company can do. For instance, the company cannot easily merge with another company, sell off most of its assets, or take on a lot more debt without potentially getting into trouble with the lenders. It is all about protecting the lender's money. And of course, there are things that would be considered a default, meaning things that could make all the borrowed money due immediately. The big ones are not paying back the loan or interest, breaking the rules we just talked about, failing to pay other debts, or if the company runs into serious financial trouble, like bankruptcy. This exhibit is the actual legal document that officially added the new terms for these notes to the original loan agreement. It is dated the 21st of November 2025, which is just a few days after the report date we saw earlier, showing how recent this all is. This exhibit is basically the template or the actual look of the notes themselves. It shows what the debt certificates would look like if they were physical certificates. And the report is signed off by Kristen L. Guillory, the Chief Financial Officer. This is standard procedure for these types of filings, showing that the company leadership is aware and responsible for this report. The same CFO also signs for Cleco Power LLC. This emphasizes that both the parent company and the operating subsidiary are involved in this significant financial transaction. So, what does this all mean for Cleco? They've raised a substantial amount of capital, which they need to manage their existing debt and operations. This signals a need for liquidity and potentially a strategy to optimize their debt structure. On one hand, securing $350 million indicates confidence from investors and the ability to tap into financial markets. However, taking on more debt, even to refinance existing obligations, increases financial risk. The interest payments alone will be a significant ongoing expense, and the restrictive covenants mean less flexibility in future strategic moves. The fact that these notes were sold privately also suggests they are targeting investors who can handle risk and are comfortable with less liquidity. It is a balancing act between managing debt and ensuring the company's long-term stability and growth, especially in the utility sector, which often has high capital expenditure needs. The key will be how effectively they deploy this capital and manage their debt obligations moving forward. Alright, that is our breakdown of Cleco's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think this debt move is a smart play or a risky gamble? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives just like this. And don't forget to check out the Discord link in the description to join the conversation. Thanks for watching everyone, see you next time.